So this question is from Adulai, who is actually joining us from Sierra Leone. What is the major principle you use when assessing the risk of investing in a business?
Well, there are different types of investments. If you're talking about a buyout investment, they tend to be companies that have revenues. You can analyze the revenues. You can analyze the quality of the management team. So what you do is what's called due diligence, where you do a lot of work on the quality of the earnings, whether the business has got a good management team, whether in the future the earnings are likely to continue because the product area, the service they're manufacturing or they're offering is still likely to be popular. But in the end, you have to, also the purchase price has to be reasonable. You can have a great company, you pay too much, it's not going to work. You have a terrible company, you buy it at a cheap price, it's probably not a good idea either. Venture capital, you're really backing much more on the entrepreneur, whether the entrepreneur has the motivation, the drive, the skill set to take a nascent idea and take it to fruition. So it's many different things. It's not easy. In the buyout world, every deal won't work. In the venture capital world, probably 90% of the deals won't work. So you just, you have to get used to losing money from time to time. And if you've never lost money in the investment world, you're not really in the investment world because everything won't work out the way you think it was. In investment committees, every deal looks like it's going to be 10 times your money. And of course, none of them wind up that way.
Okay, next question in the audience.